Thank you very much. And yes, being a Liverpool fan these days is not very easy. I have ingrained it in my children's minds that they must be Liverpool fans. I couldn't tell them the result from last night, unfortunately. It set them off on the wrong footing. I'm going to keep my comments fairly brief. We'll have a chance to chat a bit later as well. I think that the thing that really hit me today was when Professor Coe was talking. It was nice to hear somebody being optimistic. Okay, it's very different that we hear somebody being optimistic in the current environment. I travel around the region talking about, obviously, global financial markets and investments, and everybody is scared of their own shadow. And indeed, they are challenging times for investors. We can see all the challenges that we have in China, in Europe, and even in the US. We believe this will lead to bouts of volatility in financial markets, and we believe, we predicted that we'd see one over the last few weeks, and that's indeed what we're seeing, obviously, ahead of the fiscal cliff negotiations. But they will be bouts. And what we've seen over recent times is that every time we see a bout of weakness in equity markets, the markets then go on to make new highs thereafter. Why do we get these bouts of volatility? Well, effectively, we're recovering from a balance sheet recession in the West. So debt to GDP in the US, total debt to GDP in the US went up to around 358% of GDP. In the Great Depression, ahead of the Great Depression, it went up to 300% of GDP. So debt levels in the States were higher ahead of the current situation or the global financial crisis than they were going into the Depression. Europe, obviously, not to the same degree, but also has significant debt challenges. The issue there is you need to get yourself out of that debt. And how do you do it? You can either default, you can impose austerity, you can try and grow your way out of it, or you can inflate it away. Okay, those are your four choices. Default, the Greek route, obviously is not very popular. The austerity route has been tried and tested in peripheral Europe, which is clearly not a way to resolve the challenges there. Growing it is very challenging because every post-war recovery in the US has been driven by higher debt, so therefore would be self-defeating. So we believe inflation is the key thing to watch out for. That's the downside argument. However, we do believe actually that we're getting into a more constructive environment. So if we're looking over the course of the next 12 months, what are we seeing? Well, we're seeing US growth is accelerating. Right? Undeniably, it's accelerating. Even without corporate America investing, the economy is actually accelerating. Not to the 3.5% growth that we were used to pre-crisis. That looks to be a pipe dream at the moment, getting back to there. But it is doing better. Housing market's doing a lot better. That is going to increase wealth effects. It's going to allow people to refinance mortgages. It's going to create a boom in housing construction. And that's all very positive for the US economy. China is also showing early signs of coming out of a cyclical slowdown. Still has the structural concerns that Stephen spoke about. But overall, the tail risks that we're seeing in the economy or in the global and financial system, we believe are reducing. China will avoid a hard landing. Europe, the tail risk there to us, and I beg to differ from esteemed panellists earlier, the tail risks there are much reduced. Why do I say that? Well, long-term refinancing operations have created a ring-fence to the banking sector. OMT has ring-fenced the sovereign debt markets. Greece, of course, can leave. Who cares? Really, I mean, it is a small country. The reason it might stay in is actually because it's so small, actually the check to write to keep it in is not that big. But at the end of the day, we believe that the single currency will be largely intact and will move, as Professor Coe indicated, towards more integration. So given that environment, we see the overall environment improving as we go into next year. Now, at the beginning of this year, and I'll cover this briefly, we can talk about it more in Q&A. Beginning of this year, we came at what we talked about, the VIP strategy. V is for manage and use volatility. I is for protect against and prepare for inflation. And P is being paid, i.e. invest in investments that pay you some income. In mid-year, we added the first V, if you like, value. I think the key thing here is we see the environment being very favourable for equity markets as we move into 2013. Clearly, there is one big but. The US politicians need to get past this fiscal cliff. If we get past this fiscal cliff, we believe the US economy will remain on a recovery path, and given where equity markets are currently priced, they will show the strongest returns out of all asset classes in 2013. Thank you very much.